China's exporters are flooding global markets with dollars, while the White House threatens embargoes that could send shockwaves through the global economy. Meanwhile, Amazon has been accused of pushing Chinese propaganda by showing price hikes on its platform. This isn't diplomacy, this is economic warfare. And Scott Bessant has just issued an ultimatum that could shake a $25 trillion economy to its core. So, ask yourself, what happens when the world's largest consumer market goes to war with its biggest supplier, and both sides believe they will emerge victorious? Bessant didn't hesitate. On live television, he delivered an ultimatum, one that could tip the scales. He demanded China de-escalate first, or the US would escalate further. But that confidence? It may be built on shaky ground. Bessant's argument is simple. China needs the US market. After all, it exports 5 times more to America than it imports. Statistically true. But contextually, it's incomplete. According to China's Ministry of Commerce, exports to the US accounted for just 2.12% of China's GDP in 2023, down from 3.5% in 2018. The truth is, Beijing's exposure to the US is shrinking. Meanwhile, the US remains deeply reliant on China, especially in critical sectors. If Bessant's strategy is built on a misreading of leverage, it could all collapse under its own weight. But that's not the only fault line. Scheduled cargo volumes from China are plummeting. Hapag-Lloyd, one of the world's largest container shippers, confirmed that 30% of bookings have been cancelled. Projections for May suggest shipments could grind to a halt entirely. At the Port of Los Angeles, China currently accounts for 45% of inbound traffic, meaning nearly half its volume is now at risk. This isn't a temporary bottleneck, this is a systemic choke. When store shelves empty, demand doesn't wait. It spills into inflation. Fewer goods competing for consumer dollars mean prices won't just rise, they'll surge. And if you think that's hyperbole, just look at the situation unfolding in electronics, tools, and apparel. Inventories are tightening. Restock delays are stretching from weeks to quarters. So what happens next if US supply chains can't fill the gap? The 245% tariff on Chinese goods wasn't just high, it was prohibitive. Retailers didn't just absorb the cost, they canceled orders. Major importers in home goods, hardware, and consumer electronics are halting shipments rather than paying a 3-fold increase at customs. Bessant argues that US retailers had pre-ordered, but pre-ordering doesn't sidestep tariffs. They're charged upon entry, not purchase. And there's no workaround, unless companies start smuggling, which is not just illegal, it's implausible. The only viable option left? Walk away. And that's exactly what's happening. Industry analysts from Bloomberg now predict a 32% contraction in Chinese origin imports by the end of Q2. This isn't about resilience, it's about the breaking point. When the cost structure becomes unsustainable, the whole system starts to crumble. But here's where the illusion truly shatters. Elasticity doesn't mean recovery, it means delay. US manufacturers can't simply replace Chinese suppliers overnight. Even as Vietnam ramps up production, transport costs from Saigon have risen 15% month over month. Tariffs on Vietnamese imports are currently at 10%, set to skyrocket to nearly 50% once the 90-day tariff pause expires. Substitution isn't solving the crisis, it's inflating it. JP Morgan analysts now estimate that supply substitution strategies are 20% more expensive than pre-tariff Chinese imports. What does that mean in real terms? Higher prices on store shelves, thinner margins for businesses, and a deeper strain on consumers' wallets. Meanwhile, US manufacturers still depend on Chinese components for everything from pharmaceuticals to auto parts. If there's slack in the system, it hasn't shown up yet. So what's Bessant truly betting on? His strategy is grounded in a controversial economic belief that deficit countries win trade wars because they need us more than we need them. But historical precedent doesn't support that view. Take the 1980s US-Japan trade standoff. Japan weathered the storm longer than expected, despite a trade surplus, due to tight capital controls and diversified markets. China has learned from that history. Its Belt and Road Initiative and the rise of yuan-denominated oil contracts have reduced its dependence on US trade. In contrast, the US consumer is dangerously exposed to foreign volatility. A 2024 study by the Peterson Institute found that US households bear 92% of the cost of tariffs via higher prices, while foreign firms adjust pricing only marginally. So if Bessant is wrong about China's breaking point, could he be misjudging America's too? The numbers suggest he might be. In 2018, China's exports to the US totaled $478 billion, representing 3.5% of its economy. By 2023, that had fallen to $420 billion, or 2.9% of GDP. Projections for this year show a further 12% contraction. That's not collapse, that's insulation. Meanwhile, China has increased exports to Southeast Asia and the Middle East by 22% during the same period. The dependency argument is rapidly losing its force because the pivot has already begun. The danger now isn't that China will collapse, it's that China will adapt faster than the US can react. And if that's the case, the consequences will land right here at home, first. But just how catastrophic could the fallout truly become? When Bessant alluded to using his escalation ladder, he framed it as a last resort. But the unspoken message was clear. What the United States is contemplating now isn't merely a slap on the wrist. We're talking about embargoes on specific Chinese goods, possibly including critical sectors like aviation parts and tech components. If those measures are put into place, retaliation from Beijing is inevitable, and we're looking at a scenario where entire sectors of the US economy could be paralyzed by the severing of essential supply chains. Consider this. The National Association of Manufacturers reports that more than 37% of US firms rely on Chinese-sourced materials for core production. Cutting off these goods won't cripple China, it will cripple American production lines. And Wall Street is watching closely. Goldman Sachs has already warned that aggressive embargoes could knock a significant 0.9% off US GDP growth if enacted in the third quarter. But this isn't just a prediction, it's a ticking bomb. And some signals suggest that the fuse has already been lit. The Atlanta Fed's latest estimate for first quarter GDP? 2.5%. That's a stark reversal from the 1.6% growth just the quarter before. And if that number holds, the US could be officially halfway into a technical recession. Analysts at Bloomberg point to weakening consumer demand, tariff-driven price hikes, and shrinking inventories as primary culprits, meaning the trade war has gone from a geopolitical talking point to a tangible drag on economic performance. The real kicker? With $514 billion in new federal borrowing planned this quarter alone, according to Treasury data, the government has precious little room to maneuver. The markets are already reacting. 10-year yields have spiked to 4.52%, and mortgage rates have surged past 7.1%, suffocating credit-sensitive sectors like housing. The U.S. economy isn't merely teetering on the edge, it's beginning to tip. But what if Bessant doesn't stop there? What if he pushes one step further? The exodus from the US dollar is no longer just a theoretical concept. It's happening in real time. The dollar is under siege, not by governments, but by Chinese exporters who, faced with a weakening greenback, are turning to the yuan. Since late March, the dollar has already lost 5.7% against the yuan, despite Beijing's efforts to stem the tide. The logic is undeniable. Hold on to dollars for too long and you lose money on conversion. This isn't retaliation, it's survival instinct. Exporters are cutting their losses before the dollar's decline accelerates. This shift is creating a far-reaching instability. Now, the threat to the dollar isn't coming from central banks, but from the very exporters who once made it their currency of choice. Cross-border settlements in yuan surged by $23.8 billion in April, largely driven by private sector demand. It's not just the yuan either. The Japanese yen, Swiss franc, and even the Russian ruble have gained ground against the dollar. This is not speculation. It's real, practical risk management. And this behavior isn't just a trend, it's becoming structural. Once the global economy starts normalizing this shift, the dollar's erosion will no longer be a phase. It will be irreversible. But this erosion has far-reaching consequences. It's no longer just about currency markets. It's starting to bleed into policy, pricing, and even perception. The trade war has hit home in a very real way. Amazon, at one point, considered labeling product pages with real-time tariff impacts, showing customers how much more expensive products had become because of the tariffs. While Amazon later retracted the idea, the damage was done. The political response was swift and furious. In a White House press briefing, the idea was denounced as a hostile and political act, accusing Amazon of collaborating with Chinese propaganda, an accusation made without any evidence. But the fact remains, price hikes are no longer abstract. According to the American Apparel and Footwear Association, tariffs have already added as much as 35% to the final price of key retail goods. This is no longer a distant issue, it's reached the consumer checkout line. And the administration's furious reaction suggests they know this. The strategy Bessant is betting on hinges on a fragile theory, that China's economy will buckle under pressure before the US consumer does. But the data tells a different story. A 2025 report from the National Bureau of Economic Research found that 62% of US retailers still rely on Chinese manufacturing for more than half of their inventory. If China stops exporting and the US economy continues to slow, the tables will turn, and Washington may find itself on the receiving end of the pressure. So what happens if the bluff is called? The damage to the supply chain is no longer hypothetical. It's already happening. US container imports from China have dropped 29.8% year-over-year in April, and logistics forecasts show no rebound in sight. Major shippers like Maersk and Evergreen are slashing sailings to the US due to irreversible volume losses. Retailers like Home Depot, Walmart, and Target have already reduced their orders from Chinese suppliers by over 35%, based on data from the Port of Long Beach. The ripple effect isn't just on the water. Warehouse backlogs are shrinking, inventory lead times are stretching, and small businesses are reporting widespread stockouts. Whether or not Bessant escalates further, the damage is already in motion. The shelves may still seem full now, but the pipeline has already been sealed, and soon, the true costs of this trade war will become inescapable. Now, if Bessant follows through on his full embargo threat, the consequences could be catastrophic. Banning critical goods, like aerospace parts, semiconductors, or industrial components, would immediately grind U.S. industries to a halt. And that's not to mention the retaliatory actions from Beijing, cutting U.S. companies off from rare earths, solar panels, and essential electronics inputs. Wall Street is already pricing in these risks. Goldman Sachs's Trade Exposure Index has fallen to a 9-month low, and the Federal Reserve is now estimating a 70% chance of a recession by the third quarter if these measures go forward. Bessant may have issued his threat expecting China to blink, but the real question is, will Beijing fold, or will the U.S. economy buckle under its own red line? If he doubles down, who will break first, China or the American consumer? We'll leave that for you to consider. Thanks for watching. Please like and subscribe, and check out another video that's now available on your screen.